think I'm going to use about 5 minutes quickly. So this part basically is based on the BIS quarterly review special feature article, which is going to be public on the 15th of June. So what I'm going to show you, strictly speaking, is not supposed to be public. So that's one reason I asked the press to sort of wait until mid-June. The basic motivation of this part is the two things. Korea, by one measure, experienced the most severe turmoil in the FX funding globally. So that's one motivation. The second one is Korea is only one of a few countries which actually has used FX reserves and swap at the same time globally. So in that sense, this part is sort of interesting to see what Korea has done. And the focus is more on which policy measure was more effective in terms of mitigating the tensions in the FX swap market. So before 2007, Korea had structural demand-supply imbalance in the FX swap market, especially the FX forward market. There was a strong demand for US dollar in the FX forward market, starting by the exporters and investment funds. And the supply side, meaning the buyers of FX forwards, there was no natural buyer, so they rely solely on foreign bank branches in Korea. And this sort of structural imbalance contributed to a persistent deviation from the CIP, the cover interest parity. I'll show you, especially if you look at this part. From 2005-6 until 7, there was a small but sort of persistent deviation from the CIP, the parity value, and then it sort of spiked up later. And the second reason was from 2005 to 7, Korean banks increased lending rapidly, and this increased lending was sort of funded mostly by wholesale funding, and including the foreign currency wholesale funding. And also there was a maturity mismatch in the balance sheet of domestic Korean banks. So basically the situation was long-term assets, US dollar assets, were covered by short-term dollar borrowing, and that became a big issue later. So as you see here, since 2007 summer, you see the sort of spikes there. So Korean FX swap market showed already some sort of tension in the early part of the crisis, and after Lehman bankruptcy, as you see, there was a huge spike. The deviation was around 11 percentage point, which is by far the highest. Against this funding sort of pressure, US dollar funding pressure in Korean market, there has been series of policy measures. If you look at the measures before August 2007, the focus was more on the sort of slowing down the US dollar borrowing by foreign banks branches in Korea, and also there was some concern about the strong appreciation of Korean won. And then situation changed dramatically since 2007 summer. So Korea was one of the few countries which actually, in the emerging market, actually sort of felt the heat of banking outflow. And Korean banks found it gradually very difficult to fund US dollar. So Korean government authorities reacted by relaxing the borrowing restrictions, and also central bank conducted one-off liquidity provision, US dollar provision in the market. And of course, after 2008 September Lehman bankruptcy, there was a severe deleveraging going on globally. And like the previous case, like the major currency pairs, Korean banks also suffered a lot from the deleveraging. And basically the interbank borrowing became impossible. They relied heavily on the FX swap market. So all the pressures came on the FX swap market. And against those pressures, the Bank of Korea basically used, Ministry of Finance also supplied US dollar using the reserves, and Bank of Korea used basically two operations. One is what they call Bank of Korea swap auctions, but using the FX reserves. And the other type of the operations was Bank of Korea's loan auctions using the funds from the Fed swap. So I'll call BOK RES. It's basically the BOK funding US dollar using the reserves, and Fed swap is BOK providing US dollar using the funds from the Fed swap. And this chart shows that, first of all, the FX reserves of Korea, the red line, quickly decreased up to after, especially around the Lehman bankruptcy. And then Bank of Korea, the green line, first started by providing US dollar using the reserves, and then later they used FX swap. So these steps basically show every step, meaning there was one auction, and each auction provides some amount. It goes up and then slowly decrease. And one thing you have to note is the BOK reserves. The Bank of Korea's dollar funding supplying operation using the reserves is 1-to-1 with the decrease in the FX reserves. So when BOK, for example, swap out 4 billion one day, and then FX reserve in terms of counting decreased by that amount. On the other hand, Fed swap is basically something coming from outside, so that doesn't affect the FX reserve. So to find out exactly whether those two policy measures, BOK, so supplying US dollar using the FX reserves, or supplying US dollar using the Fed swap funds, I run a simple econometric model. I use the model used by Naohiko Baba, Mike Corser, and Frank Pecker. So we used the eGarch 1.1 model and also eGarch 1.1 in mean model, and check what's the effectiveness of those two policy measures. And what we find out is the second bullet, policy impact. We find out that the CIP deviations, in terms of reducing CIP deviations, meaning reducing the pressure in the funding market, the BOK operations using its own reserves was not very effective. On the other hand, the Fed swap operations, BOK operations funded by the Fed swap, was economically and statistically important, especially if you look at each auction, regardless of the amount, the CIP deviation fell by 13.2 basis points. And every $1 billion auctioned out, CIP deviation fell by further 9.2 BP. So but there were more than 10 auctions. If you sum up all the auctions by the auction date effect and also auction amount effect, the total is about 2.8 percentage point, which is about 30% from the peak to the almost bottom of the CIP deviation, which is about 9%. So it's a very substantial amount. And this sort of shows the different specification consistently shows, as you see the Fed swap, the bottom line, Fed swap 1 is the auction date, Fed swap 2 is auction amount, and they are both significant. On the other hand, BOK RES 1, meaning the Bank of Korea supplying US dollar using the FX reserve, not very significant. So what's the implication in terms of policy? So there are many reasons. Actually, we looked carefully at the different sort of auction details, and we found out that there are actually not many differences. So BOK swap using its own reserves, and Bank of Korea's sort of loan auctions using the Fed swap funds, they are very similar. And after controlling for many things, we still find out that Fed swap was more effective. And we view that this is mainly because the Fed swap was a net addition to the FX reserves to Korea. So that sort of helped the regaining confidence of the market players. And I guess more important question is what's the ultimate goal of FX funding related policies? There are two goals. One is stability in the financial market, and also the providing FX funding to the real sector. And those two goals sometimes doesn't go in the same ways, so there can be some problem. And after this whole problem, Korean authority introduced prudential measures on the FX liquidity side for Korean banks. And especially the issue in Korea is not just on the FX liquidity sort of ratios itself, a more systemic one, meaning the funding, US dollar funding comes mainly through the foreign bank branches, or foreign banks in general, foreign investors. And then the issue is there is some sort of a systemic risk, meaning if one Korean bank is in trouble funding dollars, meaning all Korean banks are facing the same situation, but they are getting funds from the same group. So this sort of event should be systemic. So there should be some sort of consideration about how to deal with this systemic funding liquidity risk facing Korean banks. Okay. Thank you.